Oh, team. Happy Friday. You're stopping by to say hi. We got a lot to talk about today. Lot to talk about today. It's a lot going on. Some of it's good news. Some of it's bad news that could be good news, could turn into good news. There's some fear circulating in the markets. I'm seeing more and more and more of these real estate crash videos on YouTube. People love that idea of a real estate crash. But let me tell you, most important message I have today is do not be discouraged by this market. Do not be discouraged by lack of inventory. Don't be discouraged by how hard it may be to get into a home. I'm seeing people on the other side every day, people who are winning and they're getting in, and we're just about to sign closing documents on one of the hardest ones we've had. And they're so happy and so excited, and they're so up on this house already. You know, people a year ago when the pandemic began, real estate got crazy. And people were like, this is nuts. I'm waiting. I'm not going to get involved with this. The people who stuck it out, who fought the good fight and got into their real estate are already up huge. And I'm telling you, what we could see in real estate may make that look like peanuts. And I'm going to show you some of the things that are going on right now. I have to show you the actual stories. I have to show you what's really happening, because you wouldn't believe me if I just came up here and told you, hey, this is what's happening. This is what's being said. You wouldn't believe me. Now, the only thing I ask, let me take care of the veterans who are looking to buy a REFI home. My NMLS is 155010. My phone number's on the screen. You can call, text, email me. That's what I'm here for. Let me help those veterans. Let me make sure they get a great deal on their home loan, okay? And encourage them through a difficult time to buy a home with the VA loan. It's a difficult time to do that. Okay, here it comes. First of all, we're going to take a look at mortgage rates. And we're looking at the Fannie Mae coupon. We're not looking at the Ginnie Mae's or anything like that, but we follow the Fannie Mae. There's a lot of coupons to follow. This one is the one that we track. And so, again, mortgage bonds going down means mortgage rates going up, and mortgage bonds going up means mortgage rates are going down. So look at this. Since the end of March, we've had a nice run here. And this morning was very, very exciting. I mean, this was a big green bar this morning, okay, when it got all the way up to this level. It was a big green bar up to here. And I was like, whoa, we are off to the races, folks. Because, if we beat this, I've actually got to pull the timeline back out to January so we can see it. If we beat this guy, if we can get through this guy here, my goodness, this is all-time highs right here, or AKA all-time lows for interest rates. So we were really excited. Pulled back and basically stayed right here the rest of the day, just stopped. So that's most likely the Federal Reserve dropping a big market order, trying to move the market more than it would naturally, and then putting the hold up right here, just putting the limit buy order in, won't let it go below that. So it looks like they're going to march this thing up. That's what it looks like. It looks like, I could be wrong, of course. I still lock. I don't trust them. But it looks like they're stair-stepping this thing. Look at the stair steps here. This isn't very typical of a natural market. This looks like a manipulated market, which we know it is. Admittedly, we know it is. Today, so that's mortgage rates real quick. We'll come back to this. Today, jobs report, terrible. The expectation was 1 million jobs added to the marketplace, and 266,000 were added. So this is very, very bad. But Derrick, the stock market continues to go higher. The stock market does not care about reality. Obviously. When does the stock market care about reality? The stock market doesn't care. This is bad. Okay, this is legitimate bad. Now, the stock market can sometimes view bad news as good news because they will expect more intervention from the Fed. But look what the Fed has recently said, and this is probably the biggest thing to pay attention to, because we're going to talk about stocks, how that relates to bonds, and also how these bonds may be cueing us to a warning that the Fed has just provided. You almost never see this. This happened yesterday very late in the day, okay, past 5 p.m. Fed warns about potential for significant declines in asset prices. Whoa, as valuations climb. What do you mean by asset prices? What are they talking about? And when has the Fed ever been a soothsayer about the markets like this? When have they ever come out and issued a warning? That tells you something, okay? What are they talking about, though? Are they talking about real estate prices? Are they talking about cars? Are they talking about cryptocurrency, stocks? They don't even cover cryptocurrency. So it's definitely not that. Are they talking about bonds? I don't think so. Stocks? Maybe. Let's dig further. Real estate? Maybe. Maybe they are talking about real estate. Maybe they're talking about cars, big tickets. Key points. Rising asset prices are posing increasing threats to the financial system. The Federal Reserve warned in a report Thursday. Fed Governor Lael Brainard said the situation bears watching and points up to the importance of making sure the system has proper safeguards. Oh boy. Asset prices may be vulnerable to significant declines should risk appetite fall. Well, that just seems like common sense, doesn't it? If risk appetite falls, then yeah, asset prices would decrease. But you'll notice that immediately in here, what they're talking about is stocks, okay? Rising asset prices in the stock market. This is what they're talking about. Rising asset prices in the stock market and elsewhere, okay, they add and elsewhere, in the stock market and elsewhere are posing increasing threats to the financial system, the Federal Reserve warned in a report Thursday. Why? Why are those causing threats? Why would stocks going up cause a problem? Oh, that's right. It's BS. The whole thing is a charade and has been for a long time. I pulled up this because I know, hey, we have some casual viewers here. We have some P1s. We have some people who kind of pay attention and just want the gist of it. And then we have some people who have hundreds of thousands or millions of dollars invested. You may want to pay attention to this. Now, I'm not saying that the stock market is going to crash. I'm telling you that the Federal Reserve just told you that that is likely. Not likely, but possible. They said it's possible. If the risk appetite decreases, you could see some serious drawdowns here. We're not seeing it today, not after a terrible jobs report. So I don't know. Maybe it's not coming. Look at this. Here is this drawdown right here. This is the PE ratio of the S&P. So it somewhat signifies price, because when the PE drops, a lot of times it's because the price drops, especially when it drops sharply. Like you can see here it's off the charts here, by the way. That was the Great Recession, the crash of 2008, 9, and 10. This right here is 9/11. That was brutal. Brutal. This is the dot-com bubble. So you can kind of see the scale. Dot-com bubble was small. 9/11 was massive. Great Recession was absolutely enormously huge. Look at where we are right now. We're at a 45 PE. This is the S&P. So this is the average S&P 500 PE ratio. So the whole S&P 500 on average has a forward price to earnings multiple of 45. Now, value investors back in my day of learning how investing worked would only buy companies with the PE of 10. 20 was considered to be an aggressive PE. You would only buy something with a 30 or 40 PE if it were a massive growth company that was going to produce extreme compounding growth in revenues. The average of the S&P 500 is 45. So this is now above where we were before the crash happened in 2001, the 9/11 crash, which is really, the end of 2001 and through 2002 and beyond, actually. It was brutal, and lasted a long time. A lot longer, actually, than the Great Recession. Because this provided a serious buying opportunity. I mean, even in 2009, early 2009 was a great buying opportunity. So this is sort of setting up for something violent. Now, will this go higher? Will this just trickle down? Could it do that? Yeah, all those things could happen. But I want you to pay attention to this. Jobs report. So here's the three things we're looking at. Okay, and then we're going to talk about how this connects to real estate and what the potential is for real estate as we head into the end of the rest of this year and going into this weekend. I want people to fully understand what we're looking at here. Remember, I did a video not that long ago, said something's got to give. Stocks can't go up forever, crypto going up forever, real estate going up forever. Something's got to give. At some point, it has to. And my guess was that it would be stocks. Now, here we are, a month later, and look what's going on. Jobs report is awful, which shows one of two things. Either the economy is actually much worse than everyone thinks, or the people who are doing these estimates are complete bozos. One of the two. It could be a combination, but it's got to be one of those two, right? Okay. Now, here's actually a really good article, MSN.com, which is via MarketWatch, how the April jobs report reveals two very different Americas and how essentially COVID has created a lot of problems for people who are already struggling financially. It's a really, really interesting read if you want to check that out. I'll post the link. So we have terrible jobs report. We have the Fed. By the way, the eve of the terrible jobs report, the Fed is saying, hey, asset prices in the stock market and elsewhere, they say and elsewhere, whatever that means, but they specifically identify the stock market are posing increasing threats to the financial system. Threats to the financial system. They're not even talking about, hey, they did say significant declines, right? That was a quote. But they're not saying it's going to crash. They're saying it's a threat to the financial system. Why? Because when you have a crash, remember what happens in these crashes? It causes lots of people need to be bailed out. And all sorts of, there's a cascading negative effect. And so if that's what they're worried about, the risk of the cascading negative effect of a significant decline in our stock market crash, I don't know about you, but my antenna are up for sure. Now, they have been for a while. I've been sharing with you the things I've been invested in. Dividend stocks, AT&T, IBM, Verizon, ExxonMobil, Chevron. I've been telling you this for some time now, a couple months at least, that I want to position myself in such a way that if the stock market takes a big hit, I'm in the right place, because that was my expectation. Then I pulled this up. S&P PE ratio is at 45 currently. That's crazy. That's overvalued potentially by 100%. In other words, if we saw a 50% decline in the S&P today, if the S&P went from 4,200 to 2,100, it would still technically not be a bargain. At least by my graybeard standards, it would still not be a bargain to buy the S&P. I don't think those 500 companies are going to do that well in the coming year. Now, maybe they will. Maybe the reopening will just cause a flurry of positivity and money flowing through. Maybe it will. Let's talk about what happens here, and let's actually go to, now this is our final potential clue that things might be going poorly for stocks. We know about inflation. Warren Buffett has told us, confirmed for us, significant inflation, very significant inflation. Janet Yellen admitted as much, saying that rates needed to be raised. This is all just in the last week. And we've seen bonds, which should be dying on the vine. By the way, these bonds should be just getting absolutely torched at this point. By the way, say hi. We're live on Facebook. Say what's up if you want to. Start a conversation, ask a question. I'm all for it. Not just going to be a soapbox guy forever. So these bonds should be getting set on fire with the amount of inflation that we're talking about. The arch enemy of bonds, inflation. We see stupid inflationary signals and warnings. Why are bonds going higher? Two possibilities, right? Federal Reserve manipulation, which we know exists. Maybe that's the only thing. Maybe the sellers have just kind of gone away. They already sold everything they wanted to sell. They've kind of gone away. And now the Fed just gets to kind of pick, stair step it up. Or the other possibility is that the rotation has already begun. And while you get to see a headline of a new all-time high in either the S&P or the Dow, have you noticed it's rare that happens the same day? It has, but very rarely. Usually it's the Dow hits a new high today, or the S&P hits a new high today, or the NASDAQ hits a new high today. Almost as if they're spreading it out. Spreading out the good news to keep dumb money coming in, buying everything at the top so they can shake you out eventually. A theory. Not necessarily fact, just my opinion. not financial advice. So if we look at this and go, all right, so since, April, this is all ahead of things, right? The bond guys know. They know more information than even the stock guys. They start buying bonds again. And we got some really interesting, candles like this one here. There's a lot of buying there, a lot of thirst. There was some big green candles all along this bottom area here. It actually started back here. We had a little bit of a collapse in bonds. Had a couple really bad days. This is, I believe, the first real inflation, and then here all of a sudden there's buying. Wait a minute. Which trumps which? Is hyperinflation worse for bonds than a crash is for the stock market? Right now, what it looks like and what's possible is that bets are being placed that the inflation is not as bad for bonds as a crash might be, an imminent crash might be for stocks. This is another signal. If the stock market does take a big heater, we will know that this was an indicator, but we won't have confirmation until that happens. However, it makes sense. If that's setting up, this is what this would look like. Now, what does this mean? The Fed warned of significant declines in asset prices, and when they actually stated it, they said the stock market and elsewhere. Where's elsewhere? Well, if you haven't been paying attention to the cryptocurrency market, there are a bunch of cryptocurrencies, like new ones, some old ones, some really dated garbagey ones that have gone up unbelievable amounts. Dogecoin, Ethereum Classic, Bitcoin Cash. These have gone up huge amounts in just recent days. Let's call it this week. There will be crashes there, and I do believe that's all a Wall Street setup too. I don't know if the Fed's in on it, but it for sure reeks. So the Fed is warning about significant declines, and particularly stock market. They call that one out, and then beyond the stock market, they just say and elsewhere. Does elsewhere include real estate? Okay, let's talk about that. Is real estate on the chopping block? Is real estate going to get taken down with the stock market if the stock market goes down? Let's look at what we know for sure, and then we can make a reasonable guess. And I began this video by saying, stay steady. If you're fighting the good fight, trying to buy a property in this market, it has been difficult. Stay engaged. We talked about this, not yesterday, I think the day before. Don't go sign a 1-year lease. Get a month to month. If you're sick of it, you can't take it, and you need to take a couple months off, don't go commit yourself to rental. Do something to give yourself some time to see what happens next. And this is exactly the reason why. Because if the stock market does take a deep dive, there will be a moment of opportunity, at least, maybe a month, maybe 2, where people get a little bit freaked out. And that might create some opportunities for deals in real estate. It might. But if we continue to see a flight to bonds, because remember, if the stock market sells off, we should expect these bonds to go higher. Right now, that looks like what's going to happen. Look at the trajectory. Based on this current trajectory, we could expect to see, be back at the all-time lows in mortgage rates by June, maybe July. So we could see all-time lows again in mortgage rates by June, July. If we see the stock market suffering, where do you think money's going to go? A ton is going to go into cryptocurrency, and that's happening now. That's going to happen. There's basically a spigot of money that's just was going into other things. It's going to be going to cryptocurrency. There's no way around it. And that's going to continue to run for a long time. That's why cryptocurrency is going to do really, really well over the next 5 to 10 years. The adoption rate is just too low. It has to go up. But there's going to be winners and losers in there. And so choose wisely. Choose wisely if you're getting into that space. Don't buy Dogecoin. But if things do work out the way we're prognosticating here, and the stock market does come in, money will go into bonds, rates will go lower. That will fuel more real estate purchases. Also, money will come out of the stock market and go into real estate, in my opinion. The catalyst that drove the real estate market frenzy was the pandemic. There is some concern that the reopening would then undo that. Because remember, the pandemic, people are locked in your house. You have to stay at home. You pretty much have to just live there. So people want a new home because they want something they can stay in 24/7. Well, now we don't have to anymore. All of a sudden, hey, I was been at the beach twice in the last week, which we don't go to the beach that much. But my nephew's in town. Took him boogie boarding for the first time. Took him boogie boarding for the second time. And we're seeing tons of people at the beach. Nobody's really wearing masks. Things are starting to get back to the normal. I saw very few people wearing masks. 1% maybe. If things start to get back to normal, people start to get out more. They start to do more discretionary spending. They're less worried, but it can wait. Buying a house can wait a little bit. Let's wait till the frenzy dies out. In the meantime, we'll just go out and have dinner more often. That's possible. That's totally possible. However, what you may not see in a stat, what you may not be able to digest just hearing my words, ask around. Don't take my word for it. There is a lot of people on the sidelines, qualified individuals who've been pre-approved in the past 3 to 6 months who are just waiting. They know what they want. They know where they want to be. They know what kind of home they want. It's just not priced the way that they can afford it. And so there is a layer of support right now underneath these current real estate prices. People who've been watching the market go up and up and up, they haven't seen it go down because it hasn't for a decade. So if they see any kind of pullback, there's going to be people all over these homes, which is why I do not believe that the concern should be for real estate. In fact, I think everyone who does not own a home should make sure that that's their number one financial priority. And for people who are investors and are looking to diversify their portfolio, I know I've talked to a lot of people recently who are doing that. They're trimming out. They're trimming out of the stock market. Trimming out. And I totally understand. I mean, look, it just goes up all the time. That can't last. Oil almost $65. That continues to rise. It can't last forever. So the bad jobs report also, by the way, means what? It means more stimulus probably on the way. In fact, here was the story from Biden who said, the weak jobs report shows the need for massive jobs and families' bills. What does that mean? Money printer go, brrr. Here it comes. Line up the next stimulus. It's on the way. A few trillion more dollars. Who does that help? Who is that good for? Well, it's just more inflationary, juice put into the pot. So more inflationary juice into the pot means most likely higher real estate prices and also higher cryptocurrency prices. Inflation has actually become the friend of cryptocurrency. So best thing you can do right now, in my opinion, is rebalance, reevaluate your stock portfolios, heed the warning. The Federal Reserve has issued a warning about significant declines in asset prices and specifically mentioned the stock market. Heed that. Take a look at your portfolio. Take a look at your allocations. At least rebalance. Maybe you trim some off, 10, 20%. Talk to your financial advisor. Maybe put some money in cash to buy for a rainy day or to diversify into something else. A lot of people I know are diversifying into real estate. Look at what's best for you, but heed these warnings. Okay, I don't do these videos to be like, see, I was right. That's not the point. The point is to wake you up to what's going on so that you don't realize it 3 months from now and go, oh, I wish someone had told me what the hell was going on. I'm trying to tell you right now. Real estate is one of the safest places to be. That's going to continue to be the case through this hyperinflationary cycle, which could last years and years and years. So be ready, be nimble, be ready to pull the trigger. If you see an opportunity on a property, don't go, oh, well, there'll be a ton more. Pull the trigger. Because if you get the chance to get a deal in a short-term moment when the stock market comes in, if the stock market goes down 10 or 20%, some people will freak out. They'll pucker up a little bit. And that may cause some buyers to leave the marketplace for real estate. If it does, and you have the chance to get a deal, you know what the market is. You've been looking at it. You've been looking at homes. You've been trying to write offers. That could be your perfect opportunity. I'm not saying it will happen, but I'm just showing you all the facts here as they line up. It very well may. And if you get that opportunity, take it. But whatever you do, don't give up. Do not give up on your opportunity to own a piece of America. Now, if you are a veteran, like many of the people that I work with, you absolutely deserve to own a piece of this country. And everyone else, you had best, because it will not be something that is available forever. Our great-great-great-grandchildren may not be able to buy real estate. They may not. There's only so much of it. So take a look at what you can afford. Take a look at the market. I'm not saying be frantic, but be patient, be persistent, stay after it. This is going to be crucial for winning in real estate and for getting a deal in a situation in which real estate has become king. Cash is no longer king. Cash is really trash right now. No, cash will help you get a house. You got to put some money down, right? But keeping your money in cash is not the place to be. This is hyperinflation we're talking about, folks. And so having money in cash in a savings account is losing money because of the cost of capital. It is literally losing money. It is losing purchasing power every day. So if that continues to be the case, we're going to see tons more cash deployed. Where's it going to go? I think the majority of it's going to go to real estate. I think there's going to be a lot of it that goes to cryptocurrency, but I think the majority of it is going to go to real estate. The majority of the cash that hasn't been deployed will go to real estate. And if it goes to the stock market, then it's probably dumb money, because we literally just had the Federal Reserve warn. And now what's interesting is they did this late in the day. So you didn't get a live news feed coming in. Hey, the Federal Reserve has just made an announcement that they see potential for significant declines in asset prices, and specifically mentioned the stock market. You didn't get that. They did it after hours on purpose. This was not a live feed thing. This not that they're trying to bury it, but it's a CYA. It's, hey, we have the information. We see what's going on here. We need to say something. We need to, mention this. Now, it doesn't specifically for this day, like, oh, well, tomorrow they're talking about. No, they're just talking about the overall situation. And that's the reason why I wanted to look up this S&P 500 PE ratio, because we're now higher on this valuation than we were before the crash in 2001. Now, the crash in 2001 was caused by 9/11. So we would have you believe, we don't know if it's really true or not, but it's very much in lockstep with the timing. But the dot-com bubble burst, and then we had a big run-up. And for those of you who were around then and who were trading then or who invested then, it was kind of crazy, because we all were like worried that this dot-com bubble, Y2K, there was all this crazy stuff. It burst. It wasn't that bad. And then there was this massive bull run, which seemed to be got the head cut off of it by 9/11. And then, of course, there were some very dark days there for years, and great buying opportunities, as it turns out. I actually bought a lot of stocks in here. And so, the run up past that before the Great Recession was just absolutely crazy, completely crazy. Look, it's off the charts. I don't even know where the number is. It's absolutely off the chart. And that crash and that fall was also very quick and hard. So, which one are we in for? This can't just keep going up. Realize that, right? You can't. And if there's anything that might be overcooked here, it could be companies, because if you have a weak jobs market, that doesn't really show growth. That shows you that there might be a lack of growth. Well, a 45 PE ratio says that the market has priced in significant growth. That's average. The S&P 500, all 500 companies, the average PE is 45. So the market has priced in significant growth. Jobs report is telling us growth isn't really there. But hey, Derrick, the stock market keeps going up anyway. Something's got to give. Something's got to give. I think it's going to be the stock market. I think real estate's going to win. I think cryptocurrency is going to win. That is where my bets are placed. And I would just encourage you, this is not financial advice, but I would just encourage you to maybe take a look at your portfolio. What's up, Donald? You're very welcome, sir. You're very welcome, sir. A Missourian. What's going on? Who's also here in San Diego. Great to hear from you, friend. Yeah, and feel free to comment anytime on these broadcasts. I won't pull them all up necessarily, but happy to do so when possible. I'm just saying, take a look and stay bullish on real estate. Don't let them shake you from what you know is right. And, owning your own home versus paying rent is an obvious no-brainer. We could go through all that again, but there's no point in it. Where it gets interesting is on the investment real estate side. I do think here post-pandemic, we talked about this a couple of days ago, the eviction moratorium is gone. So there could be some sellers coming to the table. If we have sellers coming to the table, if we have reopening that hurts demand, if we have buyer exhaustion, there are some things that could cause real estate to take a breather for a second. There are. That's specifically why I am making a point to say, if you see an opportunity to buy, do not think the market is crashing. If you see an opportunity to buy, if you see weakness in the market, jump on it and do it fast. Because most likely the breather that we will experience will be short-lived as people realize, wait a minute, I'm just making up the scenario. I lost 20% of my stock market. My cryptocurrency wallet seems to be doing fine. Our house value is doing fine. We need to get into real estate more. So there's another layer to this. There's a whole nother leg to this market that's coming. And I just want you all to be prepared for it. Be prepared for it. Look at your risk tolerance. Look at your actual true diversification in your investments in the stock market. Maybe rebalance at the least. Maybe shave some off the top. Talk to your financial advisor, but be careful out there, team. Have a great weekend. And I will be here. If you have questions about the VA home loan benefit, if you know a veteran who wants to buy or refi, have them give me a call or shoot me a text, shoot me an email. That's what I'm here for. Here to help veterans get a great deal on their home loans. You guys have a great Friday and an awesome weekend. I'll see you soon.